Welcome to the daily update, where I'll go over the action in the market for Thursday, August 17th, and then we'll see how things look for Friday, August 18th. And again, this is all one take. I'm still dealing with an arm issue. It's making it very painful to work the mouse. I know that sounds real wussy and everything, but it really is quite painful. So I'm having to record things in a little different way. I can't edit things when I record it this way. So you're going to get my coughs and fumbled words and mix ups and all that stuff. So here we go. We had another down day. Yes, the trend has been down. We've been seeing some weakness in the market. We're starting to get to the point where we're getting more oversold, and some indicators that haven't flashed oversold signals in a long time are starting to do that now, or at least getting close. We're also getting to some areas where we need to be careful here. And what I've done is this is kind of a hybrid between the long video that I usually do and the short video that I usually do. I've kind of merged them together, and I'm trying to show you the charts that are just telling us something right now. But please know that for the most part, everything is still pointing down. We are quite negative. Please be aware that I am planning a class on where I'll be covering technical analysis, different strategies, and support and resistance. That'll be happening in September. I'm still waiting to hear some information about, will it be Monday, Tuesday, Wednesday, Thursday, and then what day the full class will be when I just go 3 hours in one shot. No matter what day it is, I'm planning on 12 to 1 p.m. Eastern time for the 1 hour sessions, and then 12 to 3 for the day that we do the longer session. Once I can finally get some answers, I will put some dates out there, see what kind of feedback I get, and then just go with it. A lot of you have expressed an interest in coming. I don't know if you'll be able to because of the logistics. Your time zones are different and so forth. I'm just going to show up, and if I'm the only one there, I'm going to hit the record button and start going anyway. That's usually how I do things like this. All right, let's go back and talk about what happened. We did close below 4,400. Not a real big technical level, at least yet, but the financial media likes to point this out. The different articles that you might read point this out. It's just one of those psychological things. The current scenario that the market is getting stronger with developing is that the economy is stronger than expected, and that the Fed is going to have to keep rates higher for longer. Okay. We knew about the rates higher for longer part. We've heard that. In the recent economic reports that have been coming out, they are showing that we're stronger than expected. A lot of these reports are coming in much greater than what was expected at the time. And the expectations are what's baked into the market. So then we have to adjust that once the final report comes out, and then that can shake the market either higher or lower. But we've been seeing a general trend right now with economic strength coming in with the economic reports. Not so much in the economy, but they're coming in stronger than what they thought they were going to. And there's even this fear that the Fed might have to raise rates. There's been the scenario thinking that maybe the Fed can keep the rates at about the same level. Well, as these reports come in, now there's more of a fear suggesting that they may need to raise rates after all. And this will change, this will jockey all around between now and the next Fed meeting, and it's likely to change 2 or 3 times. But this seems to be the general scenario. The Dow did fall below its 50-period simple moving average. That was the last holdout that we were watching, and I talked about this yesterday. Now, all of the indexes that we follow are below their 50-period moving averages, and some of them are even starting to come down to their 200, and I'll show you some charts there. On a short-term basis, it's getting a little bit longer. We have the 20-period exponential moving average study. That's getting extreme negative, or you could say becoming oversold. The Stochc RSI, the Williams percent R, the CCI 14 and 20, the stochastics, the force index, that's a new addition, and the RSI 9. That's going up a little too far too fast, suggesting that maybe we're getting a little too fearful too quickly. And I have a chart of that to show you. Some of these other ones, I don't have those charts because it's just repetition. In the intermediate term, please excuse my throat clearing. We are seeing our list start to get a little bit longer. We already had the S&P 500 McClellan oscillator. Well, now the NYSE McClellan oscillator is also on that list. The PMO studies, the VIX going back 9 periods, and I think I mixed this up. The RSI 9 periods, that's short term. The VIX 9 periods, that means fear is going up a little too far, too fast. Our standard deviation chart, we're starting to get down into that third standard deviation now. The percent B and the short-term version of the boom indicator based on 20 periods. The dollar was up and interest rates were up. This has been the story for pretty much the whole week, and this is putting a lot of pressure on stocks, especially interest rates going up. All of the yield curves that we follow are still inverted. Sentiment is now neutral. We dropped down to 46 where we had been at 52. Our trend is negative. The ADX continues to weaken, but on a short-term basis, we're starting to see it turn back up, although it's still below 20. We are suggesting maybe that we're switching some kind of a trend, and I don't know if that's going to end up being positive or negative once it works its way out. Our bias continues to be negative with another down day, and the last number of days have been down, so our momentum is negative. The economic reports that came out, and I just have the list to show you. I didn't bring up the charts. Weekly jobless claims came in about as expected at 239,000. Last time it was at 250,000. The continuing claims are going up at 1.716 million. Last time it was at 1.684 million. The Philadelphia Fed Index, this came in greater than expected. It came in at 12. They expected -9. Last time it came in at -13.5. The leading indicators came in as expected, down 0.4%. Last time it was down 0.7%. Here's just a quick look at the initial claims. That's the red line where they are starting to come down slightly. We're seeing a general decrease in the continuing jobless claims. That's the blue line. And then a couple of weeks back, we got the unemployment report showing that the employment situation is still strong. This could give the Fed justification for raising rates. Here's the intraday chart. We had a higher open, but just like yesterday, we got stopped right at the daily pivot. We were not going to go higher than that. We ticked a little bit above it there for a second, but then we came down to the unchanged level, which tried to act as initial support. We fell below that, came back above the unchanged level. Then later in the day, this is when we started to see more weakness. We came down to S1. We tried to hit some support there. That wasn't happening. We came down to S2, went a little bit below S2, and we closed just a little bit below S2 for the day. Looking at the growth to value ratio, now this is somewhat positive. We're seeing growth outperforming value. It held up fairly well yesterday, and it held up even better in today's session. So maybe some smart money is coming in, buying some growth stocks on weakness, waiting for this mess to get cleared out before things get set to go higher. But we don't want to base everything on just what we're seeing on one day. We're just saying, okay, for right now, this is looking a little more positive. Keeping an eye on the VIX where it's going up pretty sharply. We're still at a low level overall. We haven't even come back up to the 20 level yet, but it's been rising pretty fast, both with the line chart as well as the bar chart, and we closed pretty much at the high for the day. Looking at the volatility of the VIX shows that volatility is really picking back up as well. Here's the VIX based on the RSI 9 period, showing that we have gone up a little too far, too fast. We're just barely into this extreme category right now. We could go a little bit higher than this. This is just something to be aware of. This is also something that potentially could be positive. We've been really rising with the equity put call ratio based on the 5-period simple moving average. That's negative in and of itself. But when we cross above this upper line, sometimes we top out around here, and that can mark a bottom in the market. We don't know when this is actually going to top out. We just have to keep an eye on that, but this is something to be aware of. Here's a longer term look at that chart where we're crossing above this level right now. Now we could go a lot higher than where we're at right now, but just know we're in that territory. Looking at the 3-month average of the VIX as well as the VIX right now, and then taking a ratio, Sorry about the throat clearing, folks. Where we are turning back up with the red line, showing that fear is coming back in. Also looking at the VIX and then a ratio with the volatility of the VIX. This is longer term. As it has been declining, that's been positive for the market. We're still starting to turn up a little bit right now, and we're wondering, is it going to continue to go back down, or are we going to start to go up and see more negative action coming into the market? The longer term equity put call ratio is also starting to turn back up. Again, it's done that before when it has declined, but we're wondering, are we seeing a major shift here, or is this just some kind of a pause in the uptrend while we're going down right now before the market gets set to go back higher? We just want to be aware of these things. Accumulation distribution is also showing continued weakness. This is showing that the smart money is selling into this market right now. We got the latest reading from the American Association of Individual Investors. They have dropped in their overall sentiment. They're pretty much neutral right now. We see the red line has been coming up. That's a moving average, but we're still below zero. We're also watching a short-term deterioration of the risk on, risk off ratio. It has really been declining. It had been going up nicely in the intermediate term, but now in the short term, we're seeing this start to fall off a bit. Here's the condition of our trend. We see the ADX just beginning to turn back up, but it's still below its moving average. The red line is on top, so we default to negative. If we can turn up and go above the moving average without dropping below 20, that might actually suggest a change in trend without necessarily going into a trendless environment. But on the short term, we are below 20. We are turning up. We're still below the moving average, and the red line is on top. We would still default to the negative, and in the short term, we're seeing a real weakening of the trend. Here's the daily chart where we continue to fall down here. Will we come back to the August 2022 highs? This has acted as support before. Are we going to come down and test this level again? We saw a bit of a pickup in volume, but it still continues to be below average. Here's the 20-period exponential moving average starting to get extreme negative. It could go further than this. We just want to know when it gets into this part of the chart. We're also declining with the 50 and the 200-day exponential moving averages. The force index, it went down pretty far, pretty fast. It's hitting the lower Keltner band here, suggesting that it is oversold. The boom indicators dropping below this 100 level right now, suggesting that we've gone down pretty far, pretty fast. The 50 and the 200, the 50 has now crossed below zero, and that's more negative intermediate term, where we are seeing a decline with the 200 period, but it hasn't dropped below zero, at least yet. Looking at our moving average tree, we're dropping well below the 50-period moving averages. Are we, in fact, going to come down and see what the 100-day moving averages have to offer? We may not get that far, but we may even slice through this. So we'll have to see how that works out. Here's where we're coming into the third standard deviation on this chart, suggesting that maybe we've gone down a little too far, too fast. The S&P 500 McClellan oscillator is still getting extreme negative. So when we look at the summation index, we continue to decline based on price, but we're still above zero. However, based on volume, we're declining and we're below zero. The NYSE McClellan oscillator is also starting to get extreme negative. So when we look at the NYSE summation index, which this is a broader measure of the market, we're declining based on price and volume. We're also starting to break below this trend line with the NYSE advanced decline line. We've done that before and we're able to bounce back up. But again, we just want to know when these things happen. The Chaikin money flow, it was extreme after yesterday. It's even extreme negative after today's session. And the other times that we've seen this reading, especially back in October when we hit that major low, we're seeing similar kinds of readings to what we're seeing now. So this is potentially suggesting that we are oversold. Looking at the RSI on 14 periods, we're below 50 and declining. With the 9 period, this is the one I put on the list, we are starting to get extreme negative, meaning more in the short term, we've gone down pretty far, pretty fast. Looking at our PMO study, we're starting to get extreme negative with the PMOs that are rising. We're getting extreme negative with the buy signals. We continue to decline with the PMOs that are above zero. The MACD, we're coming down to this 0 point. It was kind of hope maybe it would find some support right about now. Nope, not yet. It's still in a pretty strong momentum downtrend. The ultimate oscillator starting to get extreme negative, and the percent B, we're just barely coming down to the lower Bollinger Band here. If we see more weakness, we could drop to an extreme negative reading. The Ichimoku cloud, I pointed this out yesterday. We were at the top of the cloud. Now we're starting to come into the cloud. Will it offer some kind of support as it's in this green cloud? And this is longer term, and I haven't shown this chart in a while. This is our longer term trend study. We used this to validate when we broke above this trend line. And at that time, the MACD was positive and continuing to go higher, suggesting that this breakout was legitimate. I think we pretty much have settled that and enough time has passed. However, on the weekly chart, the MACD is starting to roll over and potentially giving a sell signal. Our trend studies not really showing anything right now. We broke below this intermediate term trend. We're kind of in no man's land, seeing if we're going to come all the way down to this longer term trend line. But here's another pocket of hope. S&P growth versus value. It did well yesterday. It did well again today. Now, we need to see more follow through with this, but this is something to hang on to. We have been going sideways to down in the more short term. We're still in an uptrend in the longer term. We're also bringing up our fib charts again, having to keep an eye on this. We're still above this 100% retracement level, but we're getting a little close. We're at 43.76 now for the S&P. This is at 43.25, so roughly 51 points away. We just want to see if we come down here, will this end up providing some support? Our longer term fib chart, we're also coming back down to the 61.8% retracement at about the 43.13 level. We're still a ways away from that, but if we really start screaming to the downside, we'll be seeing if this offers some kind of support. This must be the most useful chart I'm showing here. So you gotta love Google Slides. All right. Now, looking at the Dow, it was the last holdout to finally fall below the 50-period moving average. We're looking at the NASDAQ 100. Also, the momentum continues to be down. We're not looking like we're setting any kind of a bottom here, at least yet, as we're dropping below zero. That was kind of the hope. That's what happened back in March. Although when we fell down in December, we went lower than this and then saw a nice run up after that. So we're waiting to see if we're going to get any kind of a turn back up with the PPO. The NASDAQ also dropping down below its 50-period moving average, but still above the S2 level as potential support. The NASDAQ, after coming back down through the 61.8% retracement, now we're coming down to the 50% retracement. We're still above it for right now. Are we going to test that level? And if we do, will that provide support? You notice that we came back up here. This is where we set the August high. This is going to be a big area if the market decides that it wants to take this on right now. Looking at the NASDAQ 100, below the 50-period moving average, but still above S2. The NASDAQ 100 bullish percent index continues to decline, but it's not extreme negative yet. Looking at the fib chart for the NASDAQ 100, coming back down to the 61.8% retracement level. We're still above it, but we just want to notice that we're seeing that kind of off into the future a little bit potentially. The small caps, they not only broke below their 50-period moving average, they've now broke below their 200-day moving average. That's more negative. The mid caps also broke below the 50-period moving average and are still headed lower. They're still above their 200-period moving average. The dollar, and this can be blamed for a little bit of the strength, it continues to go up. We're into the 103.47 area after dropping below 100. This is what caused a lot of problems in 2022 was this upward move that we're seeing in the dollar. That put a lot of pressure on stocks, and it could be causing some of the problems that we're seeing now. We're also seeing a real increase in interest rates. The bond yield, we're getting up above 4.3%. That's a pretty high level compared to where we were at not so very long ago. Longer term with the S&P 500, we're falling a little bit further below this resistance level. And this is good. Okay, I just showed this chart. All right. And then looking at the NASDAQ 100, we're also falling a little bit further below the resistance level. This is a long-term weekly chart of the NASDAQ 100 to Dow ratio, where we topped out in 2000 and then saw some real trouble. We topped out in 2021 and then saw some trouble. Are we going to continue to come down here? And is that causing the market to shift to a more negative tone? The jury's out on that right now. So far, it looks like we haven't done a lot of damage longer term, but we want to watch these things just in case we do end up seeing a shift. According to Tom Bowley, in the month of August, which tends to be the third worst calendar month, there we go, calendar month, the energy sector is not hot, and it's been hot lately, and tech has been hot. Well, it's been weak lately. We're in the middle part of August now, where we should be seeing some kind of a bounce. We're also seeing a little bit of what he's talking about here with growth outperforming value, but we need to see more follow through with that. So what's our outlook for Friday? We will get some more earnings reports. The technicals are negative, and we're starting to get oversold. We've already been oversold in the short term. Now we're becoming more oversold in the intermediate term. We won't get any economic reports. It's a Friday in the middle of August. Volume is likely to be light, but you got a lot of people really watching what's going on now as we're getting close to this potential tipping point between just a pullback and an all-out switch into a more negative environment. We're keeping an eye on the geopolitical events, but it's about inflation, interest rates, and growth concerns right now for the market. We've completed all of the economic reports that were due to come out this last week. The Stock Traders Almanac statistics, we're neutral to negative pretty much across the board with the Dow, S&P, and NASDAQ. I didn't point out yesterday, but we are dealing with options week. Friday will be options expiration. That can be kind of a crazy day in and of itself. And in that regard, we might see a pickup in volume where we tend to be up historically 54.7% of the time for the week, where we're down 45.2% of the week. Unless we have a monster rally on Friday, we're probably going to end up being down for the week. Here are some charts that suggesting historically we should be seeing a bounce right now, but we're just not seeing that. We follow the dashed, the green dots here, where this is about where the S&P is. In fact, it's dropped a little bit lower now, where we should be seeing some kind of a historical bounce, but it's not happening. We're also wondering about that same thing for the NASDAQ. We're getting beyond that time now where historically it has bottomed out and starts to show some recovery, but we're just not seeing that yet. And then looking at the S&P 500 during pre-election years, where we follow the green line, where historically we've seen kind of a nice bounce during this time, but it just hasn't materialized yet. We will be on the 14th trading day of the month, which again will be options expiration. And then we're out of this window now where historically we've seen a little bounce. We're up into the 14th trading day now. So we're kind of breaking historical norms right now. So our scenarios, we're going with the down one still. We're negative. All of our charts are pretty much pointing down, but we're also becoming oversold. We can't go with the up one. And as I usually say, it's pretty dangerous to try to front run the market. Options expiration is its own day. So if we see some action, it's likely to be reversed next week, especially if it goes counter trend to the downtrend that we've been seeing lately. Just be careful of that. We could go a little bit with the sideways trend in the short term because the ADX is still below 20, but it's starting to turn back up now. So we would default to the negative side anyway, so you might want to stick more with this down scenario until our charts prove otherwise, that we're actually starting to see a recovery. The warning signs. The mess that kind of got us where we're at right now was this convergence of these short-term bearish signals. Now we're shifting more into the more intermediate term, and things are switching a little bit more negative. Instead of saying, is it over? Now we're wondering, will it ever finish? The long-term trend signals on the weekly charts, they're continuing to come down from those trend lines, suggesting that we might be putting in a top. We don't know that, and it'll take some time for that to play out. We're just watching to see what happens. We're in a seasonally and historically weak month, but typically we see some bounce right now that's not happening. The S&P 500 oscillators are negative, and we're watching the NASDAQ 100 with the PPO. It's now dropped below zero, but no signs of bottoming, at least yet. The VIX is continuing to climb, and it's climbing pretty fast. The equity put call ratio is also getting above that line and starting to spike. We don't know if it's put in a spike yet or if it's going to continue to go up, which means the market will go down. The S&P 500, the NASDAQ and NASDAQ 100, as well as the small caps, the Dow, and the mid caps, I forgot to put those on the list, everything is below its 50-period moving averages now. The cumulative new highs and new lows for the NASDAQ are showing weakness. Even though we've been unchanged for 3 days in a row with the 3-month yield, we're still above where we were back in 2007. S&P growth is showing a little bit of improvement after it had been weakening, and we're still in a longer-term uptrend, but we want to see more follow-through with that. The parabolic SAR daily and weekly charts are negative. The vortex is negative, and then we're dealing with earnings season. And I could have added a whole longer list of all the other things that are negative right now. The positive signs, we still have the seasonality and setups that are in the background that I go through in the weekly video. That's still there. Now, one of them I'm going to have to look at because one of them might be in danger of actually going away. The long-term daily special K chart is positive, even though it continues to roll over. It's still above the red line where the weekly chart is negative. The equity put call ratio, even though it's starting to turn back up, is continuing to decline longer term. The S&P is still above that downtrend channel upper line. We haven't got too close to that yet. We're in a risk on posture, but in the short term, we're seeing a real deterioration of that ratio. The S&P is outperforming utilities. That hasn't really changed. And the staples to S&P 500 ratio is declining. That hasn't changed all that much. And usually these two things together give good support to the S&P. So where is it? We're just not seeing it right now. The Russell and the small caps, as well as the mid caps, even though they're turning kind of negative, they have all generated recent golden crosses. Small and mid cap growth continues to be positive. The financial sector, even though it's been getting hammered even more right now, it did generate a recent golden cross. So our conclusion, we are negative and becoming oversold. We are already oversold now in the short term, but we're still negative. We're negative and becoming more oversold in the intermediate term. We're still positive in the long term. Thank you. I appreciate you putting up with this and my clearing throats and mumbled words and so forth. I hope you have a really good day, and I will talk to you in the next video.